Good morning, good afternoon to everyone. Welcome to our live FP webinar. Okay, so I will just give another 1 or 2 minutes for the rest of the participants to come streaming in. For now, if you guys can hear me clearly and see my screen, please type a 1 in your chat box below. All right. Hi, Travis. Hi, Andrew. Hi there, Michelle. Nice to see you guys again. All right, I see a lot of ones. I assume that all of you can see me and hear me clearly. Okay, Julian said that she can't hear me. How about the rest? Can other people hear me as well? Julian, I see that a lot of people can hear me. Okay, so maybe you can try to log out and come in again. I hope it works for you. Okay, great. Now you can hear me now. Awesome. Okay, let me just give it like 1 more minute before we start our webinar today. Okay, while waiting, my name is Benson. I am from Singapore. All right. Do let me know where you guys are from so that while waiting, we sort of like get to know each other and get to know some, culture interaction. Okay, I see Newton is from Perth. I see some are from UK, some are from Singapore. All right, we have quite a lot of. Michelle, you can't hear me? How about now, Michelle? Because the rest of the attendees can hear me clearly. Okay, I see a lot of Australians. Travis is from QLD. Daniel is from Brisbane. David from Melbourne. All right. I hope you guys are staying safe there. I heard that the lockdown was extended. Okay, a lot of Darren from Canberra. Okay, and we also have Andrew from New South Wales. Okay, all right, nice to have a very large crowd today. And Thomas writing to us from UK. Okay. Okay. Now without further ado, I think it's time for me to start the webinar itself. Okay, so today webinar is a collaboration with FP Market and Everest Fortune Group. Today webinar will be more of like an education webinar where we go through using correlation to improve your trading strategy. All right. Just before we start, let me go through a short disclaimer. Okay, the information contained in this material in this webinar itself is intended for general advice only. It does not take into account your investment objective, financial situation, or particular needs. All right. FP Market has made every effort to ensure the accuracy of the information as at the date of publication is true and fair itself. Okay, and me as a presenter, Benson Young, okay, it's my duty to convey to you the accurate information as of this period. Okay, so just a brief introduction of who are we. Okay, we are from Everest Fortune Group. We are the award-winning research team and finalists for the Technical Analysis Analyst 2019, 2020, and 2021. So what we do is we provide institutional grade research for banks, hedge funds, fintech firm, corporate treasury, as well as my boss Desmond. Okay, appear on radio talk shows as well as TV talk shows itself. All right. So the next slide is mainly just to give the picture to the faces. So we can see on the top left hand corner is our CEO Desmond. Okay. And on the top right hand corner, you guys might be familiar with our chief market technician Isaac, who often give webinar for FP markets. Okay, and on the bottom right itself, we have Joyce, my another colleague. And for me, I'm on the bottom left-hand corner. All right. Okay, so from my experience, previously I was trading for a fintech firm using fundamentals and technical analysis and different type of scalping strategies. Okay, so for today, our main agenda is on correlation. The first part, we will be going through the education materials for correlation, and the later part, I will be going into trading view itself to show you guys how to use the correlations that is available in the trading view itself. Okay, so let us begin on what is correlation. Okay, so correlation is basically the the statistical measure that describe how the two variables are related. Okay, so for example, dollar index and euro dollar itself. So what happens is that they are inversely correlated. Okay, then so there are two variables. These two variables we use R to represent it, and there are multiple variables that require ranking. So this will be labeled as P. So what does P stand for? A P value is the probability that null hypothesis is true. Okay, so in our case, it represents the probability that correlation between two currencies in the sample data occurred by chance. Okay, this P value, for example, if the P value say is 0.05, that means that there is a 5% chance that the result from your sample occurred due to a chance. Okay, if a P value of 0.01 means that there is only 1% chance. So what it means is that the lower the P value, the better it is. Okay, so the correlation takes any value from -1 all the way to +1 itself. -1 meaning the variables are perfectly negatively correlated, whereas +1 represent perfectly positive correlation. Okay, so next I will be going into different type of correlations. All right, so I forget to mention that our webinar today will be more of an interactive webinar. Okay, so if you guys have any questions, please feel free to just type in the chat box below. All right, I will try my best as a presenter to answer all your questions in a given time. There will not be any Q&A session later, so you guys just feel free to list out your questions. Okay, so firstly, we have different type of correlation within the FX pair itself. Okay. Now we will look at the positive correlation. Okay, on the screen itself, you can see that the pound dollar and pound yen. Okay, the blue color line, right, is the price action for the pound dollar, okay, and the orange itself is represent pound yen. Okay, so you can see the positive correlation when pound dollar, looking from left to right, pound dollar, when the pound dollar drop, pound yen also drop as well. All right, so after that, when it bounce back, same goes for the pound yen. So we can see from these two pairs, they are perfectly correlated. Okay, so moving on, within FX pair itself, we also have negative correlations. Okay, for example, let me just put it out down here. Okay, firstly is the Aussie dollar. You can see it in a blue line. Then in the orange itself is the dollar Canadian. Okay, so looking from left to right as well, we can see that when the Aussie dollar, right? Okay, when the Aussie dollar drop, the dollar Canadian also surge. Okay, after it start to recover over here, you see there is a crossover with Aussie dollar as well as dollar Canadian. Okay, the crossover here, and after that it diverge into different way itself. Okay, beside FX pairs, we also have correlation between different asset classes. Okay, let me just give you an example. The example I've provided here is the correlation between SPX 500. Okay, SPX 500, the indexes for 500 of the largest company in America, as well as euro dollar itself. Okay, so the correlation here, we can see that when the SPX is on the uptrend, euro dollar is on the uptrend also. Okay, and somewhere in March over here, when the SPX drop, okay, euro dollar also start to follow drop as well. Okay, so they are positively correlated. Okay, and the recovery, if you see the recovery after this period, okay, they both recover at a correlated pace as well. Okay, another common correlation between different asset classes would be the SPX as well as the gold price itself. Okay, the price action here is not clearly stated here. The blue color line is representing, showing SPX price. The orange color showing the gold price itself. So you see that when the SPX price start to move up, gold price start to move down. Okay, so for this instance, some traders or some market participants will say that okay, money from the commodities is coming out and is shifting towards the more riskier stock market, as okay, more riskier stock market, because traders are feeling more of a risk on mood. Okay, okay, next we will also be using correlation to identify support and resistance as well. Okay, this is something I think most of you guys will be quite familiar with. Okay, so what I meant by that is that if we see those, you know, positively correlated pair, for example, like Aussie dollar as well as pound dollar itself. Okay, excuse me, Aussie dollar, pound dollar, we know for a fact that both of them are positively correlated. All right, so wherever the Aussie dollar came into a resistance level, it will most likely be that pound dollar will also be at a resistance level itself. Okay, we can see from the same period around this 1st March. Let me get out my pen first. Okay. Okay, you see over here, this March period was when Aussie dollar hit the resistance level. Okay, if we go over to the pound dollar also hit the resistance level around the same period. So that is what we are referring to as positively correlated, meaning that when a positively correlated pairs in the same time frame, okay, they will hit the resistance level at around the same timing also. Okay, and just as nice if we see the support level when the Aussie dollar start to tag the support level is around middle of March. Okay, coincidentally, this is also the period where the pound dollar also tag the support level as well. Okay, so these are the kind of correlation that we can infer from this kind of positively correlated pairs. All right. Okay, so okay, oops, I skipped. All right, next. Okay. So far, do you guys have any questions so far? Hi, Big. I see that you can't hear my voice. The rest of the participants are able to hear my voice. Can you try to log out and come back in again? Hi, David. Hi. Will the slide be available for download? For download, okay, let me ask the FP market team, okay, and get back to you on this. Okay, I see another question coming from David. How do you use price data to find R? Okay, price data to find R. Okay, to answer that, I will show you, I will give you a example of trading view after our PowerPoint presentation, so you can have a better idea of it. All right. Okay. So for now, readily view, you don't need to calculate the R anymore. It's all available in the trading view itself. Okay. Equity scalper for AXX market. Okay, so AXX market, Chandana, over here in this webinar itself, we mainly focus on Forex. Okay, so your questions, I might have to overlook a bit because we will not be diving into equities. We will just be focusing more on the Forex and commodities itself. Okay. Okay, so hi Kai, I see that you are asking about the same question on TradingView. All right, so for TradingView, I will show you guys and go through with you later after our presentation so that you all can just straight away use the TradingView function. Okay, hi Big, I see that you still can't hear me. The rest of the attendees can hear me though. Muhammad, okay. Okay, Muhammad is asking whether this only applies to Forex and commodities. No, Muhammad, this applies to all the asset class as well. Just that we are over here in this webinar, we will be focusing on Forex and commodities. Okay, okay, continuing on. we will be going through how to use correlation to identify possible breakouts. Okay, possible breakouts. Okay, so what I meant by that, let me just take out the pen. Okay, so on the left hand side, we see the gold charts, gold hourly chart, and the right hand side, we see the silver chart. Okay, so over here, gold is having support from this ascending trend line, and it broke at this ascending trend line at this moment itself. Okay. Okay, so when it broke, right, we can see that gold started breaking down first. Okay, whereas silver, it broke down later. You can see the candle up. So okay, nevertheless, the timing is around the same. Okay, what's happening is that once gold break down, right, because silver is positively correlated, so silver most probably will also follow in the same direction. Okay, so as gold break down, silver will also break down from that that time frame at that moment itself. So using correlation, okay, sometimes, okay, one of the pairs will be lagging and the other pairs will try to break out or break down first. So if you see a pair that is breaking out, most likely, okay, you can correlate to another pair, another positively correlated pair, and try to monitor whether the other pair will break out as well. Okay, so that is what we are referring to. Okay, so moving on. Moving on, it will be using correlation to identify the magnitude of move. Okay, so this is also very common among traders and market participants. So what it means is that over here, let me just take out the pen. Okay, so what it's referring here is that you see the move of Aussie dollar on the left hand side and pound dollar on the right hand side. Okay, you see Aussie dollar, there is a the breakdown of the candles. Okay, there was a drop in the Aussie dollar. Okay, so this magnitude of drop, right, okay, will indirectly coincides with this magnitude of drop for the pound dollar as well. Okay, so meaning that because it's positively correlated, okay, the magnitude of drop would approximately be the same also. Okay, for example, okay, let me just take away the pen. Okay, so over here we see that Aussie dollar have dropped for 6 bars. Okay, and is approximately down by around 4.8%. Okay, so naturally, pound dollar being positively correlated, okay, it should drop by around 7 bars, as well as around the same percentage, around in this case is 3% itself. Okay, likewise, the second instances where the Aussie dollar drop, okay, 5 bars, around 5 bars, pound dollar should naturally drop by 5 bars itself also. So that is what we meant by the magnitude of the move will sort of like correlate to each other and be the same. Okay, so we see over here, not only for the drop itself, when the price bounce back, okay, price bounce back, the magnitude of the bounce back is also quite similar as well. Okay, quite similar. For here, we can see the Aussie dollar is at 8 bars. Okay, 8 bars candle with approximately 3%. Then for pound dollar itself is 6 bar at 2.5%. All right. So this will be some of the correlation move that we use to trader use to correlate different pairs and different asset classes. All right. Let me just take some time to answer a few of the questions. All right, Muhammad. Muhammad asks, can we use shorter time frame to find correlation? Yes, of course, Muhammad. Shorter time frame. I would advise the shortest time frame you could try using would be 1 hour, because any time frame below 1 hour there will be a lot of noise and things would be quite distorted. Okay, so like those 15 minutes, 30 minutes, it's not advisable to use correlation because there are too many noise. Okay, I can show you some examples in the trading view later. Okay, Herbert, question from Herbert. Okay, do we get a list of identified correlations from you? Okay, identified correlation. Okay, so Herbert, let me just type in the message chat box. So you guys should be familiar that DXY is the dollar index, right? Dollar index, okay, is supposedly negatively correlated to euro dollar as well as pound dollar itself. Okay. Okay, so with that being said, we have come to the end of the educational slides. Do you guys have any questions from the educational slides before we move on to the trading view itself? Okay, now I will take you through to trading view itself to apply what we go through from the PowerPoint. Okay, if there are no further questions, let me just prepare the charts on the trading view. Okay, I've opened my trading view window. If you guys can see my trading view window, please type a 1 in the chat box so that I know you guys can see my screen. Thank you, Daniel. Thank you, Kelvin. All right, I see that you guys are able to see my screen. Okay, so on my screen, I have opened up euro dollar. Okay, so if you want to do comparison, okay, there is a function here, compare on trading view itself. So you click here. Okay, let me just compare with positively correlation pair first. So first pair will be pound dollar. Okay, so I will choose the new price scale. Okay, let me change it to a line. Okay, you can see that this white color price action itself is the euro dollar. Okay, euro dollar, and the orange line is the pound dollar. Okay, so if I scroll out, you can see that they are positively correlated, meaning that they go hand in hand. When the euro dollar bounce, pound dollar bounce as well, and when the euro dollar drop, pound dollar drop as well. Okay, so there's another indicator in the trading view that is used for the correlation, to determine the correlation. So let's go in and let me show you guys what I am referring to. Okay, So there is a indicator in the trading view itself called the correlation coefficient. Okay. Do you guys know about this indicator itself? Okay, so if I type in pound dollar, okay, so pound dollar, you see below this correlation coefficient, okay, has a range of +1 all the way to -1, just like we went through just now. Okay, so +1 meaning that is perfectly correlated, whereas -1 is negatively correlated. Okay, so for euro dollar and pound dollar, we can see that most of the time, okay, it is positively correlated at around 1% itself. Okay, and if let me just draw out the horizontal ray. Okay, so you see over here, most of the time is positively correlated. Okay, there are some times, okay, over here you see that is negatively correlated. Okay, so for this instance, over here, the negative correlation, right, I suspect is mainly due to the EURJPY, the EURJPY pair fluctuation. Okay. Okay, so I've just shown you an example of positively correlated. Let me just show you another example of negative correlation. Okay, so for now, I take away the pound dollar, put in DXY. Okay, let me just change the correlation symbol to DXY as well. Okay, so after changing to DXY, you see the picture change. Okay, the white line still remain as the euro dollar. The orange line now represent the dollar index. Okay, so we see that when the euro price is down, dollar index is up. Okay, so it's naturally you guys will be familiar because they trade in negative correlation. Okay, so moving down to the correlation coefficient, you see that just now previously it was at 1, right? Now what happened? Now all the markings are at -1. Okay, all -1. Okay, so just now the correlation feature that David was asking about. Okay, so this is the correlation that helps you calculate the correlation itself. You don't have to calculate the R value anymore. Okay. Okay, so just now we also go through some of the different asset classes. Okay, different asset classes. Let me just go into that to have a better view of it. Okay, so for different asset classes, I will use the dollar index. Okay, dollar index comparison with gold itself. Okay, and changing the correlation to gold. Okay, so previously we all know that dollar index and gold are negatively correlated, meaning that wherever dollar index rise, gold will drop. Okay, so this white line itself is the dollar index price, whereas the orange color itself is the gold price. Okay, looking back at the correlation, right? Okay, the correlation is not always negatively correlated. You can see from this graph, okay, most of the time is negatively correlated. You see, but there are cases where there are spikes as well. Okay, so for this, right? Okay, for this, wherever we notice that dollar index is going up, some traders will just keep in mind. I mean just try to short the goal with even though if there is no proper setup, because they think that uh, it is negatively correlated. So if dollar index goes up, so gold will naturally go down. But it's not always the case. Okay, so from this correlation coefficient, this graph itself, it tells us that most of the time it is negatively correlated, but there are times uh, where both goes in the same direction as well. Like for this period, let me just give you this period. Okay, so I've marked these two vertical period where the dollar index, okay, sort of like bouncing up. Okay, gold also had a little bit of bounce. All right. Okay, let me just take time to answer some of the question. Okay, I see one question coming in from Bartolo. Bartolo, pardon me if I pronounce your name wrongly. Please, is it advisable to trade negative correlated pairs together? All right. So, can you give me an example of one of the negative correlated pairs that you are referring to? Okay, while waiting for you to reply, we will head down to look at other different asset classes. Just now we also mentioned equities, S&P 500. So let us quickly take a look at are there any correlation between SPX as well as the dollar index itself? Okay, just give me a moment. Okay, compare with XPX. Take away this line. Let me just change it to SPX dollar index. Okay, SPX. Okay, so for as we can see here from commodities and SPX, right? Okay, the correlation is not much of that. Okay, most of the time is negatively correlated, but there are periods where it also positively correlated. Okay, so this is not always fixed. This one need to be monitored closely. Okay, if I switch it over to daily time frame, okay, just move it around. Okay, you can see this whole period of time where the dollar index is negatively correlated to the SPX. Okay, this was a period of time, if you guys can remember, is March 2020, which was last year during the pandemic period, where all the money printing started. So the dollar index dropped. Okay, But nevertheless, all the printed money from different governments, okay, looks like it have come into the stock market, rallying the SPX. Okay, hi Kai, okay, got your question. Okay, what time frame do you use on this? Okay, you can use on any time frame, but ideally, it should be 1 hour and above. Okay, any time frame lesser than 1 hour, there will be a lot of noise, and the correlation will not be that accurate. Okay, so Bartolo, I see that you are referring to euro dollar and dollar franc. Okay, euro dollar, dollar franc. Let me just go into both of the pairs. Okay, euro dollar comparing with dollar franc. Okay, changing my correlation to dollar franc as well. Okay, staying at the daily time frame. Okay, staying on the daily time frame, we can see that mostly euro dollar and dollar franc are negatively correlated at -1. Okay, almost perfect negative correlation. Okay, let me just go into H4. Okay, H4, yes, most of the time. Okay, Bartolo, something I don't like about this both pair that you mentioned, right? Okay, so what I don't prefer using this as a trade negatively correlated pair is because there are a lot of spaces in between. Okay, so what happens is that you might, in an event caught in the case where you won't be able to trade this kind of negative correlated because of this situation, like for example, this one, okay, euro dollar is dropping here. No, euro dollar over here is going up. Okay, and you thought that Swiss franc you can short it. Okay, but nevertheless, Swiss franc, okay, didn't go down as well, rather than it consolidated, then breakout. So in this kind of situation, you will be caught in your trade okay, you might end up like holding a trade in a losing position. So it's not advisable to use these two pair as a the correlated trades. What you should consider to do is rather than dollar franc and euro dollar, right? You might have a better chance with let me just take away. Okay, you might have better chance with euro dollar and dollar index. Okay, let me change this to dollar index as well. Okay, you see over here, most of the time it is negatively correlated. Okay, it don't have those gaps that just now we just saw. Okay, we over here there aren't any gaps. So as a result, right, like for example, euro dollar is going down or dollar index is going up. Okay, some trader might just consider to short the euro dollar. Okay, so for instance, you won't be caught in the wrong side of the direction. Okay, so before deciding your negatively correlated pairs, right, always remember to check for coefficient correlation in a trading view. Okay, if there are large gap in between, it is not advisable to use those two pairs to trade negative correlation. All right. I hope that answers your question, Bartolo. Okay, so let me just for forex pair, let me just give you another negative correlated instead of dollar index. So using euro dollar as an example, okay, I would just switch to euro yen. Okay, let me also switch this to euro yen. Okay, euro yen not so. How about euro Canadian? It's just searching for a pair that is like negatively correlated to euro dollar. Just give me a minute. Okay, so far euro yen and euro dollar does not have like perfect negative correlation. Only dollar index have the perfect negative correlation. Okay. Okay, answering the question to Bartolo, please show how to check correlation coefficient on TradingView. All right, so simply if you want to check the correlation coefficient, okay, I will go through it again. Okay, so this would be your chart that your forex pair that you want to go through. Let's say, for example, euro dollar, and let's say you want to compare with Swiss dollar franc. Okay, dollar franc. Okay, then you go compare symbol, you just type in dollar franc, new price deal. Okay, over here it come up. Okay, this is the graphical chart. Later on, after that, you go to the indicators, then you search for correlation coefficient right here. Okay, do you see this function, Bartolo? Okay, so when you see this function, you just click on it. They will ask you to add a symbol. So over here, you want to compare the correlation symbol, you just type in dollar franc. Okay, then it will naturally come up over here. Okay, let me just confirm. Okay, this is not dollar franc. Dollar franc. Okay, tada, you see that? Okay, so this correlation, after you change the symbol, it will automatically calculate for you the coefficient correlation over here. Okay, another question coming in from Kai. Do you know of any correlated trading pairs with significant time lag? So essentially seeing one pair move, then having more time to react and place the trade for the second pair. Well, Kai, okay, your question is quite subjective. Okay, sometimes I do see some of the pairs are lagging, but because of some reason, okay, so let me just give you an example itself. Let me see how can I give you the example? Okay, just give me a moment. Okay, let me just change it to a two screen. Okay, take out everything. Change back to candles. Okay, so for instance, I will use the example of euro dollar. Okay, euro dollar over here and pound dollar over here. Okay, let me just drop a bit everything. Okay, remaining on both remaining on the 4-hour time frame, right? Okay, you see the recent price action. Okay, just the last second last candle itself. Euro dollar was having a green candle right here, whereas for pound dollar was having a red candle. So what I meant by that is that when the euro dollar is like rebounding, the pound dollar continue to drop. Okay, so in a way, pound dollar is lagging. Okay, lagging, but lagging due to a reason. So the reason over here, I'm going to open up another window. Okay, another screen over here. Let me just remove all this marking first. Okay, so the reason for being the lag in the pound dollar, right, is actually because of the EURJPY price action. Okay, moving now to 4-hour. Okay, do you see the second last candle? What it's doing over here? Okay, it was a green candle. So that means that euro is, in this case, euro is appreciating higher, sort of like higher than pound. Okay, that's the reason why pound dollar was lagging behind. Okay, so to answer your question, right? So the perfectly correlated pairs like pound dollar and euro dollar should ultimately be positively correlated. But if one pair is lagging, right? One pair is lagging, you should try to find out the cross pair between that two pairs to see why it caused the lagging. Okay, so if you forget to like check out the cross pair, okay, if you forget to check out the cross pair technical analysis and the price action, you might be caught in the wrong side of the trade. All right, I hope that answers your question, Kai. So even in a perfect positive correlated pairs, there might be instances of a lagging pair due to the price action of the cross pair currency. Okay, you are welcome, Kai. All right, so for now I will just wait for some. If you guys got any question, please feel free to post it in the chat box. We are nearing to our end of the webinar for today. Okay, I see question coming in from Travis. Travis asks, how do you find correlation indicator on a MT4 platform? Okay, MT4 platform. Okay, for this one, let me check the FP webinar whether FP website whether they got any resources. Okay, I tell you what, Travis. Okay, so for this, right, please send in an email to the FP marketing team. Okay, so they will try to answer back to you as soon as possible. Let me just, okay, do you have the email for the FP market? Okay, because sometimes some of the brokers have different. Okay, no, you don't. Okay, let me just. Okay, over here, right here, support@fpmarket.com. Okay, I will put the email in the chat box. Okay, so that you can write into them. They do have guide to how to set up a correlation coefficient on the MT4 itself. Yes. Okay, so before ending our webinar, okay, so FP markets have lots of webinar going on. Okay, feel free to check out this webinar and sign up for it. Okay, so next week my senior Isaac will be back. Okay, taking you guys to the live trading session itself on the August 24th. So do remember to sign up for this webinar. Okay, if you prepare all your pairs in, okay, prepare the currency that you want him to take a look at, and he will go through it for you. All right. So I will just wait 1 or 2 minutes to see whether are there any more questions that you guys would like to clarify or ask about before we end the webinar itself. You are welcome, Muhammad. I hope you enjoyed the webinar. Okay, I hope you find the learning material useful in your trading journey as well. Okay, with that being said, we have come to the end of our webinar. Thank you guys so much for joining me. Okay, trade safe, stay safe. See you guys in the next webinar. Goodbye. So before trading a pair, is it important to check the correlation? Okay, before we go, I'm going to answer one last question from Thomas Winter. Okay, so before trading a pair, is it important to check correlation? Important to check correlation. What's important is to check the price action as well as the technical analysis. Okay, so if there is a good setup, then you can consider opening it. Okay, don't just blindly use the correlation. The most important thing is the price action and the trade setup. Okay, so if there are no risk to reward ratio, no good probability trade setup, we will advise you to just stay on the sideline. Okay, that's the most important, Thomas. I hope that answers your question. Okay, with that being said, see you guys. Goodbye. Trade safe, stay safe.